The shale boom in the Permian is slowing down. The promise of the Permian is shrinking. Producers in the nation's oil-rich shale basins are dialing back growth plans in the face of a growing panoply of problems that's killing returns, and keeping skeptical investors away. The constraints are manifold pipeline limits, reduced flow from wells drilled too close together, low natural gas prices and high land costs. But the most in the 5 years since oil fell below $30 a barrel from more than $100, a resilient shale industry has established the U.S. as the world's top oil producer. Now, cracks are, you're having to spend more and more every year to grow at a faster rate, said Noah Barrett, an energy analyst at Janus Henderson, in a telephone interview. Companies routine. In the early years, Wall Street had been happy to fund shale growth, framing the budding sector as a young, technology-driven industry, ripe for future returns. But as the shale most of the independent producers cut their capital budgets after oil prices slipped at the end of last year. While companies they've been burned so many times in the past that there's deserved skepticism toward energy stocks, according to Barrett, whose firm manages $328 billion. Just when we get, the smallest companies have been among the hardest hit. Times should be good for Legacy Reserves Incorporated and Approach Resources Incorporated, two small producers working in the oil-rich Permian. Crude prices are, but it's not just the minnows that are struggling. Bigger producers, for the biggest companies majors such as ExxonMobil Corp. And Chevron Corp. Battling decline. Stock offerings last year were the lowest since at least 2006 and were down more than 60% versus 2017. With public capital, other producers are tapping private capital to help drill wells outside of their regular capital expenditure program. In those arrangements, private equity investors pay to drill certain areas outside a producer's budget. Once oil flows, the strategies may be different but the goal's the same. It's really just designed to accelerate this free cash flow generation, and get these companies to try to prove earlier to investors that they are good businesses, said Rob Thummel, managing director at Tortoise, which handles energy-related assets. Such measures mean the U.S. will continue to see shale production, but the explosive surges of the past may be over, according to Janus Barrett. U.S. production in absolute terms will continue to grow, he said. But the pace of third in a series looking at the oil industry 5 years after the price rout. To contact the reporters on this story, Kevin Crowley in Houston at Crowley1@Bloomberg.net. Rachel Adams to contact the editors responsible for this story, Simon Casey at Scasey4@Bloomberg.net, Greg Gale, Carlos Caminada. For more articles like this, please visit us at Copyright 2019 Bloomberg LP.
Raindrop, drop top smoking, no cooking the hot pot. Fucking on your bitch, yeah, that. Looking up, open the park pot.